Good afternoon, everyone. Thank you for joining us today for this investment update. For those who don't know me, my name is Kel Waniforo, and I am investment specialist at Asset Intelligence. And we're just going to give you a bit of an update today about who we are, for those who don't know us, who Asset Intelligence is, who's on the team, an update on the current investment backdrop. So we'll certainly be taking a look at President Trump and his tariff plans, no surprises there. We'll cover portfolio performance, also how we think investors should be thinking about the current moment, what actions we've been taking to manage your money over this volatile period, and then we'll open up for a bit of Q&A at the end. Just a bit of housekeeping at the start. As you can see in the bottom left corner of the screen there is some important information. Of course, as ever, investors should be aware that the value of investments and the income from them can go up as well as down, and it's not guaranteed. And of course, nothing in this presentation constitutes personalised advice. If you have got any questions of that nature, do of course feel free to get in touch with your financial advisor after today's meeting. So first up, just for those who are less familiar with Asset Intelligence, who are we? So we are a Leicester-based investment research and wealth management firm. So you can see on screen now some of the key facts about us. So we've got around 3 billion assets under our purview nationally now. We were set up in 2008, so we've been running for quite a long time as a research firm. So we provide investment guidance to financial advice firms around the country. And then we've also been running a discretionary wealth proposition, which many of you today will be invested in, and that's been running for just over 5 years now. So while we're smaller and nimbler than some in the industry, we are well known, we've got a profile in the industry because we work with so many other financial advisors around the country, and that really helps to open the door to get access to fund managers, to hear the updates that they're making in their funds, to make sure our research team have got the very best information about the decisions they're making in the portfolios. We're also a registered B Corporation in our Articles of Association. So what that means is that in addition to just having a profit motive, it's written into our aims that we also seek to take care of the environment, that we have a keen social conscience, and that our governance structures are up to scratch as well. There's a lot of attributes to us, and hopefully by the end of this presentation you'll get more of a sense of who we are. But we do think we've got a really enthusiastic and engaged team, and we do think our strategic location away from the city where most financial firms tend to be based does mean we've got a bit of a different insight into how to manage things as well, and to avoid some of the typical groupthink. But who is actually on the team? We'll take a look at that now. So you see some of the key individuals on screen now. We think we've got a team with real complementary skill sets. We've got, you can see the people's credentials on screen now. Really well qualified team, as I say, very, very enthusiastic, a lot of industry experience across, sort of all the key parameters that you would hope for. Probably one figure to point out in particular is Tony Mee on the left-hand side of the screen. He is our Chief Investment Officer. He has final say over all investment decisions. And you can see there that last year he was named one of the top 100 wealth managers in the UK, and that is really quite a large cohort. So it's good to see him getting that kind of recognition for his abilities. But across the whole team, as you can see, it's really, really well qualified team, a lot of experience, and I think we as I say, each brings something different to the team while making our decisions. What is it that we actually believe? How do we manage the portfolio? So you can see our core principles on screen now. So some of the key ones. I mean, we certainly believe in the potential for active management to add value to investor portfolios over the long term. We do think with the depth of research that we're doing, the amount of different research tools and technologies that we have access to, it certainly is possible to find those fund managers in those equities, those shares and bonds over the long term, which do have that ability to add value over and above the market. And we think that's particularly valuable through difficult times like we're seeing at the moment. If you're invested in you may hear a lot these days about passive funds or funds which simply track the market. Of course, when the market goes down, they go down by just as much. So we do think there's that potential for active management to sort of lead to a bit of a smoother ride through the cycle and to add value long term. We also very much believe in running global portfolios to make sure that you have access to the full opportunity set of investments worldwide. And again, not all wealth managers believe in that. Some invest more in the UK, taking a home bias. But after a lot of research, we'll come on to talk about this later, but a lot of research by our team suggests that essentially limits the opportunities that portfolios have access to. So we think having that global opportunity set managed actively, being vigilant to what's going on in the markets, but at the same time, not overreacting. You don't want to be sort of trading all the time, reacting to every little thing, because patience is also a great way to add value over the long term, as we'll come to look at. So those are our key beliefs, which, happy to take any questions on those toward the end. But for now, we'll talk about the current backdrop in terms of what's going on with President Trump and his tariff plans. So certainly with this second Trump term has been eventful, to say the least, so far. I mean, we're only less than 3 months in, and I think it's fair to say it does feel like a fair bit longer than that in some ways. But you can see on your screens now that since he has returned, there's been a remarkable amount of added uncertainty. So one think tank keeps an index of economic policy uncertainty, which hopefully you can see on screen now. And you can see that ever since Donald Trump's return for his second term, that's shot off the charts to even higher levels than COVID. So investors have got real questions about sort of how things are going to be managed over the next few years, and of course, particularly in terms of trade. It's I mean, as the chart I think shows well, it's a remarkable sort of sudden shock that investors have experienced, with a massive increase in uncertainty. And I think that's really a reflection of the fact that President Trump has come back in this second term and done things very differently. I mean, even though he is a known quantity, which you might have expected less surprises because of that, because we've had 4 years of him already, actually he's doing things very differently in this second term. In his first term, while he was always an unconventional president, in economic policy terms, he was actually pretty conventional. He followed a sort of typical Republican sort of neoliberal approach of cutting taxes, deregulating, didn't do too much on tariffs, and actually markets responded really well to that. What's different this time is, of course, as we know, he's come in, and although tax cuts are promised down the line, he's really kicked off with this tariff plan, which is much less popular with investors. So I think just that change in his behaviour is why there's been such a change in sort of market response to him this time around. So on the next slide now, we can see the impact of his tariff plans. This chart just shows the average tariff rates, the average import tax on goods coming into the US, going back to the 1890s actually. And you can see for most of that period, as the world's got more and more integrated, as globalization has picked up, obviously, effectively the world's got smaller with shipping becoming so much more available, and obviously the internet connecting us all and so on. You can see there was a move for decades on end towards smaller tariffs, towards countries doing more trade for each other, companies sourcing material from whichever countries they thought could do it the cheapest, essentially, to the point where the US, you can see there, had a almost very minimal tariff rate until very recently, in the very low single digits. As you can see, President Trump's current plans, I mean, there's a lot of uncertainty about where we're going to end up. I think that's important to stress, but his current plans would see that average tariff rate rise from sort of about 3%, you can see there, up to about 23%. And you can see that's the highest level in about a century. So this is a big change to how the global trading system works. And it's been, although on the campaign trail he did talk about tariffs, as I mentioned earlier, I think it has still come as a shock just because of, sort of the fact he's focused on this so early. I think it's important to stress that first of all, there's uncertainty about whether he still might change course later on, and we'll come on to talk about that more later. But also important to stress that if high tariffs do remain long term, gradually that average tariff rate will still come down because companies will change their behavior. US companies won't just keep importing goods from overseas at these high tariff rates. They'll gradually sort of change their supply chains to source from countries which have lower tariff rates applied to them, or start to make more goods in the US. So we hope to see that come down over time anyway. But certainly there's a lot of uncertainty abounding, and you can see the effect of that on your screen now. So what you can see on screen now is survey responses to various different questions from the American public, just responding to what's happened. And you can see there's been big jumps in the number of people, I think no surprise, with a negative view on the government's economic policy. That's jumped up. The number expecting general business conditions to worsen over the next year. Again, the highest levels in decades are saying that at the moment. The number who've heard bad news about what the government is planning, that's also shot up again to the highest level in decades. The number expecting real terms pay increases has gone down. And the reason for that is real terms, inflation adjusted. It's because the price of goods is expected to rise. So what has happened already so far, despite some of the changes, some of the refinements Trump has made to his trade policy, it will have an effect because of what you're seeing on screen now. What matters in sort of how economies, how sort of economic outcomes, it's not just the hard data and the hard policies. Sentiment is important too. So the fact that people have picked up on what's going on in the news, have adjusted their expectations accordingly, means that this year we will see lower economic growth and moderately higher inflation than had been expected a while back. There's no getting away from that. What is important though, is I think some of the negative effects have been a bit overblown. So when you look at most of the forecasts from the sort of the big investment banks, from the economic think tanks, they are expecting, as I say, that slowdown in economic growth, but crucially, not for the US economy or the global economy to slip into outright recession. And similarly, in terms of inflation, although there will be an increase from current levels, it's still expected to stay far below the levels of 3 years ago when we had inflation at 9% in the US, 11% in the UK. Nobody's projecting, even with these higher tariffs, that we're going to go back to levels anywhere near that. So hopefully that provides a bit of reassurance. The picture is, as I say, undoubtedly less favourable than it would have been had these unnecessary tariffs not been put in place. But we think the situation is manageable rather than going to lead to sort of an outright negative picture. So just a refresher on the current state of play with these tariffs, these imports, taxes. So you will have heard that when President Trump stood there on that platform and got out his big board of the country-by-country tariffs, those have been paused for 90 days at the moment, thankfully, while he and his team seek to agree new trade agreements with the countries on that list. So that was a welcome adjustment to the plans, although as we saw on the slide a couple of slides ago, the average tariff rate is still quite high even after that change. And that's because a 10% baseline tariff is now in place for all countries. Again, if you think back to when we were looking at the average tariff rate up to now of around 3%, 10% is still quite a big change. And as you can see as well, tariffs on China have been hiked enormously to 145%. Due to what President Trump described as a lack of respect from China and China looting America over the years and so on and so on. And again, that has a relatively outsized impact, even though it's just one country, on the overall tariff rate, because China still accounts for about $1 in every 7 of all imports to the US. It is also expected, unfortunately, that further tariffs on smartphones, on computer chips, on pharmaceuticals, will also be announced shortly. So we'll have to wait to see over the days and weeks ahead where they come out at. But crucially, they are expected to be lower than the 145%, for example, when sourcing from China. They were, they've already been suspended for those particular items. So we do think it's important to consider the big picture at play when we think about the fact that President Trump, did pause those 90-day tariffs, and essentially it is that he did blink on that. He did listen to the advice of his officials, but it had gone down badly in the stock market. That very credible people with strong links to his Republican Party and the hedge fund industry and so on had said they were a bad idea. So while this, we're not out of the woods, there's still a lot of uncertainty about where we're going to end up on tariffs in the end. It's probably unlikely that we will get 3 months down the line and his administration tries to impose the exact same tariffs all over again. I think given the fact that they've had to back down on that essentially already, that they have shown that they're open to striking alternative arrangements with different countries instead of just imposing those reciprocal tariffs straight away. I think that is a positive sign that we're likely to end up in a better place than was suggested by Trump holding up that big board. So it's certainly something we're keeping a close eye on, but all investors should keep a close eye on. It has, as I was covering earlier, it's already had an impact through just people's feelings about the economy, and that will have a real world effect. But I think the worst of the tariff madness, as it were, probably is behind us. But there's no getting away from the fact that with Trump in place, it is probably likely to be a more volatile few years. But there are ways and strategies, as we'll come on to look at, that can be managed. And it's also important to recall that there are positive fundamentals still intact. So, as I was covering previously, some aspects of President Trump's agenda are positive with investors. And if you actually think back to when he won the election in November, up until the market peak in February, markets went up quite a lot on the back of his election. People were excited about his plans for cutting taxes, for deregulating certain areas of the US market. Those are things that tend to go down quite well with investors. So I think what's as I said earlier, been different about this term is he's focused so far on tariffs first, but important to remember that those proposals for tax cuts and deregulation are still going through the process of being put together by Congress in his Republican Party. So essentially that's something that markets have still got to look forward to, which I think is very positive. It's also important to keep in mind the fundamental strength of the US corporate sector. So even with everything that's gone on with tariffs so far, it's still projected that US companies will make 10% more profit in 2025 than they did last year. So those projections have come down a bit. When we came into 2025, the projection was for 15% profit growth. So that has been cut a bit, but still 10% higher than last year, even with everything that's going on. I think is perhaps better than a lot of people would expect, and important to remember. The global economy is still expected to grow again, even with everything that's going on. And as I mentioned earlier, inflation probably will rise moderately above the kind of 2 to 3% levels we're at now. But yet no one's projecting anywhere close to the levels previously. And because it looks like growth might be a bit slower because of what's happened, there is a silver lining in that, which is at least that central banks tend to cut interest rates when economic growth slows down. And historically, both equity markets, shares, and bond markets have tended to react quite favourably to interest rate cuts. So again, in most economies, the big economies, the US, the UK, the Eurozone, projections are for perhaps between 2 to 3 interest rate cuts this year, which I think would be welcomed. I think just a reminder at this point, why do we talk so much about the US? Obviously, it's very influential. We've seen that in the news a lot for obvious reasons in recent weeks. But also, it is a big part of portfolios, and we'll come on to talk about why that is later on. Now, though, just a quick snapshot looking at performance. So this chart shows performance for some of our key portfolios. They're not the ones everyone watching will be in, but we didn't want to overwhelm the screen. These are our most popular portfolios, and they do as a sort of reasonable representation of the whole range. So you can see throughout 2023, by the end of that year, portfolios were up quite favourably, and then we had a barnstorming 2024, and it is, I mean, as the red line shows there, it is unfortunately since President Trump began his second term and this tariff policy came into place, there has been unfortunately a dip in performance. I mean, of course, that's been seen in our portfolios. There's no getting away from that. It's very obvious, as you can see on screen, but also, of course, has affected the whole industry. And that's because global markets are down on the back of what President Trump has proposed. And of course, nobody likes seeing that. It's obviously, we appreciate it's difficult for you, you at home watching, when you're logging in, seeing your balances go down. It's difficult for anyone with any investments seeing that. But we do think it's important not to, to sort of overreact, not to try and panic given what's happening, and we'll take a look at why that is in these next sets of slides. So first up, we've just got a quote from Warren Buffett, who many of you will have heard of. He's one of the world's richest men. He's been investing since, I believe, the 1950s. So he's got one heck of a track record. He's in his 90s now. But I think the quote on screen, amid many clever things that Warren Buffett has said, is a really, really good one, a very important one to keep in mind. So you can see there what it says: the stock market is a device for transferring wealth from the impatient to the patient. Essentially, those who can kind of stick it out and bear the volatility that we occasionally get at times like this, times like we're going through now, tend to do better than those trying to make too many moves and sort of worrying too much and pulling out of the markets. And we'll look at why that is over the next few slides. So the slide on your screen now just looks back at all of the past occasions since the global financial crisis back in 2008 that the American market has dropped by 10% or more. And then this chart shows 1 year after that 10% drop, how the market behaved. So you can see this has happened on 8 occasions over those past 16 years now. 9 occasions. And on 8 of those, you can see the market was up. And on 7 of those occasions, it was up really strongly. So, of course, there's never any guarantee that every time will be the same. Nobody can promise that. And you can see there was one occasion 3 years ago when the market was still a bit down, even after 1 year on from that. But the big picture is that global markets, and particularly the American market, in recent years have displayed a real resilience, a real ability to bounce back from these corrections. And of course, we hope we'll see that again. But of course, can't say for sure. But the track record there is positive, as you can see. The next chart as well, slightly small, so apologies for that. But again, I think a really important message. So again, this looks at the stock market return in each year. That's your blue bars going back to 1980. And you can see that in most years, the returns are very positive, often into the double digits, as you can see there. Of course, you get the occasional bad year, the occasional down year, which you can also see. But big picture is, in most years, returns are positive and often very attractive, as you can see. But then you can also see on this chart, on the red dots, the maximum peak to trough decline in each of those years. And again, you can see in every single year, at some point, there is a decline. And it's often, again, quite a big decline. So kind of the average there, as you can see, is around 10% plus in every single year. But that doesn't, ultimately doesn't matter, because you can see even in years when you have these drawdowns, the majority, sort of the return for the year as a whole tends to be positive. So I think that's, again, a really useful one to keep in mind. Even some of the best years you can see on this chart often had quite a big peak to trough decline at some point in the year within that. Chart on screen now, again, I think a really important one. So the grey line going back 30 years just shows, again, the total return of the market, and the US market, and you can see, a very attractive return long term over that time period. So it's actually, market's up about tenfold over 30 years, which is remarkable when you think about it. And then the blue shaded areas show the amount of money that investors as a whole are putting into the market, or if it's below zero, the amount that they're taking out. And what you can see in the areas highlighted by the red boxes, are that investors tend to take out the most money, so that's the blue shaded bit being below zero, when markets fall. And of course, to a degree, that's understandable. When markets fall, it's not a nice place to be. It's understandable that people often think, oh, well, I better pull my money out then. You can see that was the case around the time of the tech stock bubble back in the early 2000s, the global financial crisis, of course, in 2008-9. So you can see there's quite a big dip there, and then people pulling their money out as a result. And again, more recently, around 2020, when COVID hit, so you can see a massive withdrawal of funds, big dip in that blue area of people pulling money out of the markets. But again, if you look, on each of those occasions, if you look at the grey line, well, what happened after that? We can see on each occasion, markets bounced back. So all the people who withdrew their money, all the people in those blue shaded areas when these times happened, they missed the bounce back. So this is so damaging to your long-term returns. It is vital to avoid. Emotionally, it's difficult. Certainly appreciate that. But the long-term track record of markets, modern markets go back to the 1880s, is that, over time they rise. They come back from difficult periods like the one we're going through now. The next couple of slides, again, I think sort of illustrate this point and illustrate why investment, I genuinely think it's not that difficult. It's simple once you know the basics, but it's not easy. And I think these two charts show why that is. So on screen now is a consumer sentiment survey that's been run in the US by the University of Michigan going back to 1952. So we've got a 73-year track record here of asking people how they feel about the economy. And what's remarkable, I really do think this is one of the most striking situations I've seen in all the years I've been doing the job. The current reading of this consumer sentiment survey is the second worst ever in that whole 73-year span. If you think about, so at the minute, consumers, ordinary people are feeling worse about the economy than they did throughout the Cold War, throughout the rocketing inflation and the turbulence and the strikes of the 1970s, throughout the millions unemployed and the 15% interest rates of the 1980s, throughout the global financial crisis of 2008-9, tech stock bubble of the early 2000s, even through COVID, sort of once in a century pandemic. This seems like an overreaction caused by the sort of blanket media coverage we've had recently of these tariffs. Now, obviously it's an important story and it has had a big market effect, so not blaming anyone for covering it, but I think it has just been the sheer suddenness and unexpected nature of what's happened, which is why there's been so much coverage and which is why arguably there's been this overreaction in consumer sentiment. Now, how does this relate to your investment specifically? That's because of this next slide. So again, looking at this same survey throughout the 70 years of data, this chart shows that when that survey has recorded its 5% best results. So basically, when people have been feeling really, really positive about the economy, on average, the 1-year return of the stock market after that point has been about 4%. So I mean, that's fine, but yeah, it tends to be that, essentially, when people are feeling really good, things have gotten about as good as they're going to get, and then they get more difficult. And that's on the red bar. By contrast, you can see that like now, when the readings are in their worst 5% ever, oddly enough, 1 year on from that, the typical market return, as you can see, has been a very healthy, very attractive 18.7%. So again, this, important to stress, isn't a guarantee that we're going to see exactly the same thing this time. Nobody can say for sure. Anybody who tells you they know for sure isn't telling you the truth. But using history as a guide suggests when sentiment gets, as negative as it is now, essentially there's nowhere else to go but up. That's been the historical experience. So again, it's a difficult thing to kind of wrap your head around just emotionally. And like I said before, I think just illustrates really well why investment, as I say, not that complicated, pretty simple, but not that easy for most people to manage. But if you can, the rewards can be very, very attractive. And just finally in this segment, again, this chart shows that we could have added many, many more points onto this. There's a few missing on here that I can think of off the top of my head. Things like Black Wednesday in 1992, for example. But basically making the point, this chart goes back 40 years, as you can see, that really there's always something to worry about in markets. But while they don't go up every year, and there's certainly difficult periods when they fall, like you can see there, as we've covered in the early 2000s, around the financial crisis, through COVID and so on, the long-term track record of practically every major market in the world is that they rise over time. And really that's what they're designed to do. If they didn't do that, there'd be no point investing in them when you think about it. That is the long-term reward for taking the risk of putting your money in the markets. Again, I think it's just something to kind of to reflect on, to mull over, because I think there's often a perception among people with less investment experience that investing is essentially a bit like a casino, that you put your money on red or black, that shares might go up or down. And of course, in the short term, that can be true. But long term, it's important to remember there is that anchorage towards real companies' profits, towards increasing human ingenuity of finding ways to do things better, cheaper, more profitably. And that's what really grows that value over time. So short term, you can have these down periods like we're experiencing now, but the long-term message is that markets get over these periodic worries of sort of this issue and that issue and these bad headlines, and they do grow wealth over that long term. So what do we recommend doing at the moment amid the current chaos? You can see on screen now. I mean, we recommend staying invested, keeping your risk levels consistent. If you are able to bear that volatility, we do think it's better to try and maintain your risk level rather than de-risking, so that you do benefit from any eventual bounce back. We don't think there's any need at this juncture to make any changes to that view unless a sort of severe recession emerges. And as I mentioned earlier, that is not our base case. That is not the base case of sort of most economic analysts looking at this at the moment. So no change to that big picture view. We do think, though, it's a time to be largely neutral in our positioning relative to the market. There is so much going on in the world at the moment. It is a very complex time to analyse. I do think people taking sort of big positions, in this particular sort of country or region, big positions different to what everyone else is doing, that potentially runs quite a big risk at the moment. So until things become clearer, at least, yeah, staying pretty neutral, I think, we think is a good call. So what actions, that said, have we actually been taking in portfolios? So, as I say, well, let's go through the list actually. So the first thing to say is, related to what I was just saying there about the picture being complex. I mean, that was something we recognised as a team kind of earlier in the year, coming into 2025, certainly because there was, we knew President Trump was coming back into office and there were questions about what exactly he was going to do. But also, I mean, not just that, when you look around the rest of the world, there's obviously been a lot going on between Russia and Ukraine, in the Middle East, certainly questions about, when you think about the UK economy, around our budget and some of the measures brought in. So certainly questions everywhere. So we did take the opportunity before the recent turbulence to kind of move our, sort of portfolio positioning back to a mostly neutral stance because of the complexity, of the picture that we were presented with. So that will have protected some capital from where we came into the year. So that involved things like making modest reductions to our holdings in some of the big technology stocks which have been hit quite recently. To the US, that was reduced as we came into the year. Emerging markets as well, they were reduced as we came into the year. So, China, which has been hit, for example, by the high tariffs we were discussing earlier, we've had less exposure to those areas that we did have at the start of the year. I do want to stress these weren't big changes because, as I mentioned earlier, you don't want to be overreacting to every little change. You also never want your investment manager to kind of think that they know absolutely better than the market and absolutely better than everyone else, and yeah, sort of taking positions that are really dramatically out of whack with the market as a whole. That runs a big risk. So these are modest moves, but they will have added value as we came into the year. We've also, as you can see on screen, after the recent falls, we've rebalanced portfolios, and we've also been topping up positions. So in areas that have been sort of badly hit over the past few weeks. So we've been sort of slicing off a bit of value from those areas that have held up. So that's our bond exposure, so lower risk assets. The portfolios also have, modest positions in gold, which again has performed very well as a safe haven throughout the recent turbulence. The team have been taking off small amounts of those areas that have held up and adding them back into shares. And what that effectively means is you're buying the shares of companies that we still think are fundamentally sound at cheaper prices than you were able to get them a few weeks ago. And we do think that will add value over the long term. And that's been made easier for those of you watching, and it'll be a majority invested in our core alpha portfolios. That's been made a lot easier by the change we made to the structure of the portfolios earlier this year, which you will have received letters about if you were invested prior to February, sort of changing the structure of the portfolios to investing in our own funds. It's much easier to make those changes. So again, that's added value compared to what we would have been able to do otherwise. More recently, we have removed a bit of US dollar exposure as well. So again, it's a relatively modest size of change, but just to provide a bit of a degree higher protection. Yes, we've added a bit more exposure to pound sterling and just reduced the US a bit just because of the volatility we are seeing over there at the moment. Fundamentally though, beyond these short-term actions, important to stress that what we always try and do is ensure that we've got a degree of resilience built into the portfolios by including different assets which behave differently from each other, just to make sure that you've got that true diversification in portfolios. It doesn't mean that they'll never go below a zero return as we've seen over the past few weeks, but it does mean that the drawdowns aren't as steep as they might otherwise have been, because we have got those, as I say, the assets which have held up better in addition to just those which have been harder hit. So it will vary a bit depending on exactly which risk level you're in, but yeah, that will have helped to keep things a bit higher than they otherwise would have been. Finally, one question, we did have quite a lot come in prior to the event, and thank you all for, if you did send a question in, it was useful when putting this together, is sort of about our holdings in the US and what the long-term picture is there, how, why have we got so much invested there? We can see on the map graphic, you can see on screen, first off, why we've got so much invested there. Those percentages, some of them are a bit small, so apologise for that, but they show the proportion by value of each of these countries, the value of their stock markets as a proportion of the global whole. And what you can see there, and it is pretty remarkable, is that the American stock market is worth about 2/3 by value of all shares globally. So it's a massively important part of the global markets. That's why it's well represented in our portfolios. The US is the biggest economy in the world, but by no means is it 2/3 of the world's economy. And what that means is fundamentally that their corporate sector has kind of outperformed even the strength of their economy. And you've got a few reasons for that on screen now. US companies have, in recent years, proved extraordinarily profitable. They've often led on technological innovation. So, I mean, if you just think of, well, how we're watching this this presentation right now on YouTube, owned by Alphabet, who own Google, an American company. I'd be surprised if many people watching don't use, I don't know, Netflix or Google or WhatsApp at least once a day. These are all American brands which have become woven into our lives. It'd be difficult to, I don't know, to walk into a restaurant and not be able to order a Coca-Cola, to drive from one city to another and not see a McDonald's and so on. So the US market has had this incredible ability to make itself profitable, to return those profits to shareholders in frankly a manner which has outstripped the rest of the world. And you can see on screen there the UK market, which once upon a time, back in 1900, was the biggest stock market in the world. Now we're only accounting for a relatively paltry sort of 3 to 4% of the global total. So we do think, although the US has been certainly hit fairly hard in the recent turbulence for obvious reasons, long term, it is where a lot of the innovation is. We think it is where a lot of the opportunity is. And if you limit yourself just to the UK, where we've not got as many of these kind of new economy companies, we've got many more sort of legacy industries like supermarkets and miners and old retail banks and that kind of thing, that would potentially limit the opportunities available to your portfolio. Now, 2 points here, well, 3, which I think are important. The first is that obviously there is a kind of long-term deglobalization going on. So we will keep that in mind over the medium term, but these things won't happen immediately. We're not going to wake up tomorrow and the US market shrinks down to a fraction of its current size, or everyone pulls their money out, or everyone stops doing business in the US. Things just don't work that way, and it can be really dangerous for investors to kind of try and get too far ahead of a long-term trend, especially if they're not 100% sure that's where we're going to end up. So we will certainly keep in mind what as I say, the long-term trajectory is, whether US kind of exceptionalism and hegemony does go into retreat. But it would be dangerous to kind of pull loads of capital from that market now based on something which is still a very uncertain development. And that kind of leads into the second point, which again, of course, we want to be using our own judgment when we're managing portfolios. Of course we are, and of course we do. But as I mentioned previously, it can be dangerous for investment managers to essentially substitute their own opinions too much for the opinions of the market. And over the years, seen some investors run into real trouble doing that. Some of you on the call, maybe I'm sure will have heard of Neil Woodford, for example, kind of. And just one example of a fund that ran into trouble when perhaps a manager's opinion and doing things too differently ran into trouble. It's just something to bear in mind when managing a portfolio, that you want to make sure your opinions are in the portfolio, but not to the exclusion that other outcomes are possible. And that kind of leads to the third point. One medium-term possibility here is that what we're going through now is an anomaly. President Trump, for example, won't be in office forever, for one thing, but things essentially return, maybe if not back to normal or back to where they were, back to something closer to that. And certainly one thing to bear in mind in that, the third point, is that there's been a lot of research done on this. Economic boycotts tend to fade. So again, it's been in headlines a lot recently that people are trying to avoid this US good and that US good. There's been a lot of research showing that actually established habits do tend to reassert themselves over time, that people fall back into old habits, but emotions tend to die down. So again, I think that's another reason for skepticism, or about the US falling into long-term decline, or another reason to kind of say that there's a dramatic need to scale back exposure there. So big picture, this is something we are talking about in the team. It's certainly a very live topic in discussion. I think it probably is the case, to be honest, that the US will perhaps never get back to quite the peaks it reached before, because it has diminished itself in terms of its demonstrated reliability as a home for capital. But the fundamental strengths of its economy and its companies will probably persist long term, even if President Trump has done quite severe damage at the moment, but longer term damage at the edges of that bigger picture. So I hope that's been useful in just giving you an idea of how we think about things, really, and what we're doing to manage portfolios at the moment. That is it for the main presentation, but I'm happy, if there are any, to try and answer any questions which have come through while I've been speaking.
Currently no questions.
Oh, okay, right, I'm hearing there's no questions at the moment, but if you have got any, please feel free to tap them into, I think there should be a live chat box or something like that on the side of the screen. I'm happy to hang on for a few seconds just to see if any come in. But if not, thank you for watching and hope it's been useful. And yes, any other questions, I'm happy to try and answer them via proxy of your financial advisors. Thank you for joining.